All right, I think we're live. Let me get the thumbs up. All right, we're live. Thanks everyone for joining today. Really excited for this webinar today on the evolution of crypto lending. Pretty diverse and broad topic, but extremely hot and top of mind for a variety of market participants and investors in the digital asset industry at large. My name is Ryan Todd. I'm a research analyst at The Block, a leading news, media, and research information services company that focuses on the digital asset industry at large. I'm excited today to be joined by a fantastic group of panelists. We have Zach Prince, CEO of BlockFi. We have Matthew Ballensweig, Vice President at Genesis Global Capital. And we have Robert Leshner, founder of Compound. What's really going to be exciting for this conversation for myself is when I joined The Block and when I first got interested in crypto and digital assets, I think the lending use case really stuck out as low-hanging fruit. It's really just a vital backbone. Credit markets as a whole are just vital backbones for capital markets at large, and it's something that I thought was clearly missing a few years ago in this space, and to watch it get built out at the pace it's been built out over the past couple of years has been remarkable, to say the least. And specifically for these guests we have today, they each come from either financial backgrounds or even fintech. They all have their own unique experiences that they've brought to the industry that I think is really indicative of just the professionalization of crypto credit markets as a whole. So really interested to hear their perspectives on a number of topics today. And I think with that in mind, just a couple of quick housekeeping items before we dive in. We're going to have this conversation last about 45 minutes. Our goal is to then leave about 15 minutes for Q&A at the end. So definitely submit any questions throughout this conversation today, and we'll try and address as many of those as possible. So yeah, let's dive in, guys. To leave as much time as possible for this, would rather focus more on not the story of the companies and organizations that you work for, but more so, let's kind of start the conversation with what attracted you into each of the either founding the companies you work for or joining the organization you work for. In Matt's case, what initially was your assumption that led you to join and look to build and operate within the crypto lending market? And how has that assumption changed or evolved? And what's been the biggest surprise so far? And let's start with Zach.
Yeah, thanks, Ryan. And thanks, everybody, for tuning in. I'm really excited to be here. I'm actually in the BlockFi office in New York today. It's my first time here in quite a while, so it feels good. So, what originally led me to start BlockFi, I was working in fintech, specifically the online lending side of fintech, and I was kind of in the middle of the peer-to-peer lending or online lending ecosystem from its inception through a couple phases of iteration and development and institutionalization. And during that time, I started personally investing in cryptocurrency. I actually bought Bitcoin for the first time in early 2015 and Ether in 2016. So end of 16, early 17, as the prices started going up and excitement around the space started to build, I was kicking around ideas to get involved in the space full time. And so the generation of BlockFi for me was really built out of, one, a personal desire to have some of the products that we've created at BlockFi and use these types of products. Two, a belief that debt and credit markets as building blocks for an ecosystem and an asset class are critically important. And then three, given my experience working in the online lending world, I felt that it was something that I was well positioned to build. Biggest surprise are things that that have changed from when we started to today. I think for us, it's mainly that our ambitions have gotten a lot bigger than just debt and credit markets, and I think I think you'll see a lot of this, and maybe there's some similar themes on Matt's end, and I'm sure Compound has evolved a ton from when it first launched. But once you get in market with some products, you start getting feedback from clients, and you see things start to work. Your ambitions grow. So our original idea, as described in our seed deck, was debt and credit markets for crypto. Fast forward to today, we really think that our opportunity is to build a global banking-like company and suite of financial services and products on blockchain rails. Expansion of our ambitions, I would say, is the biggest thing that has changed from when we started.
Nice. Matt, you want to take it next?
Sure thing. Hey guys. Thanks for hosting, Ryan. Excited to be here, and thanks for everybody tuning in as well. My story is somewhat similar to Zach's. So prior to starting the lending desk at Genesis, I was actually, I come from traditional finance background, was at Bridgewater Associates for about 3 years prior to coming into the crypto space. So Bridgewater is a large macro hedge fund based out of Westport, Connecticut, and they currently manage about 160 billion in AUM. So coming from Bridgewater, which was a very well-established, well-oiled machine, for me, I wanted something that was more entrepreneurial, that allowed me to kind of rethink how markets should work. It was really, really challenging to add value at Bridgewater because they basically had everything figured out, or at least they thought they did. Whereas, thinking about the crypto space, it was brand new. There was a lot of room to add value early on. The markets were barely evolved. I can't believe how much progress has been made in the last 3 years. But to set the stage, there were no futures markets. There was no way to get, access to spot and borrow. There was really only 3 large OTC trading desks. And so speaking with various people in the space, I decided that I think, for me, it'd be, more exciting to kind of come into, a really nascent space where I could add tremendous value, be very close to the outcomes of my work, be able to shape the actual market structure of a really, potentially exciting new space. So made the leap of faith, left Bridgewater, joined Genesis. At the time, Genesis was only 8 people. We're about 55 today. I basically joined with the mission of helping kind of figure out what was next for Genesis. And when I joined, we were really just, an OTC trading desk. So we helped facilitate, large buys, large sells with some of the early adopters and some of the, initial institutions that were dabbling, trading Bitcoin. What we quickly realized, myself along with Michael Moore, our CEO, was, we're uniquely positioned to expand our services past just, standard spot trading. And so, I think an obvious thing for us was we have a pretty large balance sheet. We have the backing of Digital Currency Group, which is our parent company. Why not expand our capability set and, be more of a one-stop shop, prime brokerage-like firm? And the first extension of trading was, let's leverage our balance sheet, our access to capital, our network, and all the institutions that we're currently trading with to offer lending. And so we said, hey, let's start by just lending out our own BTC inventory, see what the demand is like. And from there, we quickly realized, kind of to the second point of this question, like how much pent-up demand there was, not only from, on the institutional side to actually borrow for various reasons, like getting leverage on the short or long side, but also from folks just holding, digital asset balances for the long term that wanted to earn yield. And so we quickly realized there was a two-sided market, that we were uniquely positioned to offer services to kind of build a business based on that. And so we quickly scaled up Genesis Capital, which is our lending desk, to basically be the largest institutional digital asset lender in the space. And I think, the biggest surprise is, like I said, it's just one, how quickly the markets have evolved. 2, how much demand there truly is for this to continue, and like the various ways we continue building services on top of this, which we can get into later. But we've quickly scaled to be 10 billion in originations with a $2 billion active loan book. So it's just been a crazy ride over the last 3 years.
It really has, and I think what's really interesting is just these 2 parallel worlds that are existing right now and really being built out, both on the centralized lending side with BlockFi and what Zach's representing, more of this front end consumer retail focused or facing operation. Matt on the back end helping to facilitate flows and really the lifeblood of these credit markets. And now you have also the DeFi side, which obviously is super hot right now, with yield farming and liquidity mining and all these different ways to just go after yield. Granted, there's obviously different types of risks and things that come with that, but I think really interested to hear, Rob, your perspective on how we even got to all of that, your initial idea to start Compound, and how that's evolved in your view. You're also on mute.
Yeah. So at Compound, we really began in 2017. And at that time, the Ethereum blockchain was just starting to take off. And, I looked at the market and I said, wow, smart contracts are unbelievably powerful tools that aren't really being utilized to create trustless financial applications. They're mostly just being utilized for ICOs. And when we looked at the space, we said, what's the absolute best use of a smart contract in programming a financial transaction? Well, we looked at trading and we said, you don't really have to trust anyone for longer than the trade, right? Even on a centralized exchange, you can go to an exchange, you can trade, you can take your money off. You're not like forced to trust that platform for more than like a couple minutes if you don't want, right? When we looked at, lending and interest rate markets, we said, well, this is an area where you have to trust a counterparty for a really long period of time. If I want to do business with, I'm not knocking you guys, but Genesis or BlockFi, it's a long-term relationship, and a lot can go wrong the longer the time period is. And so a smart contract is really like the perfect use case to make a trustless financial interaction, because you can program, audit, and analyze the exact rules of it. You can make sure the counterparty can't run away with your money. So we looked at smart contracts and we said the perfect use case is, to reduce the amount of trust that's needed for a long-term, interaction. Interest rates are the perfect one. You have a financial transaction that spans time. It's not just, instantaneous. And so we built Compound to basically create borrowing markets and interest rates for crypto assets. In 2017, there wasn't even the phrase DeFi. It just wasn't a word yet, right? And the idea of replacing intelligent, well-run operations like Genesis and BlockFi with a computer program sounded absolutely batshit crazy at the time. Everyone said, well, you can't trust code. You can only trust well-run operations. And that's possibly true in 2017. Over the next couple of years, we were able to sort of prove out this like initial kernel of an idea that you can actually rely on a smart contract that's well audited, open source, peer reviewed more than you can trust a centralized entity. And that's been the core, thesis that we've been building on and espousing for a really long time. And so we're finally at the point now where, this morning somebody tweeted, Compound is boring. It's been running for 2 years without a single flaw. And to me, that's like the highest praise possible. You can have, an autonomous piece of like computer code running, a business function like borrowing and lending for years without a flaw. And that's what I really see as the future of a lot of financial products, is that they can run for years without you having to trust them. The longer Bitcoin runs, the more we believe in it, the more we know it's going to be there in 10 years. And I think over time, systems like, Compound can, become predictable enough that we know it's going to be there in 10 years. We know how it's going to work in 10 years. And we know that it can be, fertile ground for other applications, institutions, and users like Genesis or BlockFi. And so that's the real Compound story. And we see it slowly evolving. We don't see it quickly evolving. But I think more and more activity will be run using blockchains, not just managing blockchain assets in a database.
It's a great starting point, and I think to follow off of that, something that when you step back and just think, I like the point you make about like Compound's boring. That is the best compliment you could imagine. When you compare it to all these other things that are springing up, like that's exactly the benchmark that you want to be. Zach, a conversation we had over a year ago now that I think still just sticks out, and I think which is interesting when you're measuring the difference between Compound and BlockFi, is this idea that maybe the centralized lenders can actually offer value-added services that things like smart contracts can offer. There's definitely trade-offs between both. And maybe one day smart contracts could offer those assurances as well. But there is a difference between being able to pick up the phone and talk to someone if something goes wrong, or having a real marketing backing behind the operation you're running. I'm wondering if you still hold those views and how that's evolved, just given just purely the rise in activity and total dollar value. I don't really like the word locked, but I guess deposited within smart contracts, it's close to 10 billion now. It crossed 1 billion for the first time earlier this year. Just remarkable growth. I'm wondering, when you see these types of numbers, is your hypothesis around this idea that both can coexist, both offer different use cases, and both actually target different customer bases? I'm wondering how that's evolved given DeFi success this year.
Yeah, I mean, my super macro view that we're all kind of one team, one dream, fighting to grow the crypto asset class and make it a bigger part of the global financial system has stayed exactly the same. I also think that nothing's really changed fundamentally in terms of some of the core differences between DeFi and CeFi, if we want to use those terms. At places like BlockFi, we are regulated and have to KYC our users, which is a bit suboptimal of an experience versus something where you don't have to do KYC, both in terms of the user workflow and in terms of there are places where our products aren't available today. But the upside is that we can do things like offer bank account connectivity, launch products in partnership with traditional financial service players, transact with institutions who simply aren't able to transact in environments where the entities that they could be transacting with are unknown. And as a result, that creates some benefits for us. Client service is always something that we've prided ourselves on. That's going to continue. We're still the only or one of the few places in crypto where there's a phone number that you can call and talk to really smart people about everything that's going on with our platform and ask any questions that you might have. What's interesting about the DeFi run to 10 billion is that it's all driven by, in my view, something that Compound created, which is, hey, forget the yield we're paying you in the protocol and the actual economics of the lending part of the transaction. We're going to give you a pseudo ICO that you can only get for participating. And it's a governance token, or there's different flavors of it now, but that's what caused things to take off. And I don't think the folks at Genesis or we certainly at BlockFi don't have intentions of launching a token anytime soon. So that's another advantage. But I think there's this like fundamental difference today in terms of the percentage of assets that are on centralized or decentralized platforms being used for a lending use case, like actual kind of capital markets. I'm borrowing, or I'm taking credit risk, or I'm purely focused on the yield that's created from the lending market versus farming, which is I'm getting these new tokens that were created by the protocol, and they have a lot of value right now. So it's just very different, and there's more nuance within that as well in terms of how these things work. I think the volatility in mid-March highlighted some key differences between CeFi and DeFi. We at BlockFi were able to make some risk management decisions that were ultimately in the best interests of our clients. We have risk-absorbing capital behind the things that we do. And in an environment like DeFi where everything is always automated all the time, you don't necessarily have that same flexibility.
Yeah, and I think an interesting follow-up, just you mentioned the idea of token governance, and there's been reports that you guys maybe one day look to go to the public markets. Maybe that happens, maybe it doesn't, but I'm wondering, just from your observation, do you think there's value in giving token holders governance over lending or market protocols, or do you think it's still kind of unproven, and that shareholder governance actually still also has a place to play in some of these things? Or do you think there's actually something there with the token governance aspect and setting different rates and just even the experiment that's happening with MakerDAO over the past couple of years?
I think it's an awesome experiment. I think it's fun to watch. I think the benefit that DeFi has in terms of being truly globally open and accessible to anyone shouldn't be underestimated. I think that the governance token thing, the primary value there is that it lets you kind of more defensively back into this isn't a security token argument. I've always scratched my head a little bit on it because in a traditional setting, if you have a board of directors, if you have people governing the operations of a business or a financial services entity, you have to pay them because it's work. And so it's it's a bit like upside down versus the traditional model of capitalism and business building, which I would argue works pretty well. Obviously, it's not perfect; nothing is. So I think it's a cool thing to watch. But a lot of this stuff, when you get in the weeds, is pretty sophisticated and pretty specialized. So the experiment of can you crowdsource this knowledge and make decisions in an environment where you're competing with centralized and decentralized folks, it is certainly fun to watch.
Rob, I'm wondering if you have any comments there. Compound's largely credited now for popularizing this liquidity mining and governance tokens around these types of protocols. We don't have to talk about Compound specifically or Comp, but I'm just wondering your observations since that moment earlier this year, and your perspective on the value of these governance tokens and kind of the community governance aspect that comes with it.
Yeah. So what's funny is, when we, initially decided to distribute, governance rights of this protocol, there wasn't the phrase liquidity mining yet, right? We keep on winding up being the first, before these phrases exist. And so, our initial vision was, if you're creating a protocol that is meant to run for 100 years, like Bitcoin, you need a mechanism for it to evolve over time, for it to be upgradable. And the way we envisioned this was, well, the protocol could be upgradable through approval by a token holder class, of folks that are aligned with the vision of the protocol and are users of the protocol. And so we wanted the users of the protocol to be involved in the decision making and to be central to deciding how this system evolves. It's not a traditional centralized entity. It can move quickly. The goal is that it doesn't move quickly. The goal is that it's very predictable and slow to evolve. And so this was a first of its kind experiment to begin distributing tokens to users directly for free. Up until this point, people distributed tokens by selling them and doing other things. And so we had no idea what to expect. We had no idea what it would become. It turns out this set off the yield farming mania, first with Compound and then with every other project in DeFi saying, oh, this is a innovative way to, build a community super quickly, or to take future value and move it to the present and give it to users and to get them to use your protocol. And we've seen this in some cases experimented with, tweaked, abused, all these things over the last 3 months since, Compound took this very novel approach of let's try something crazy and distribute a token directly to users. Everyone, before that decision told me privately, that's insane. You can't just give half of a protocol to your users for free. And we said, what? Of course you can. So it's been wild to watch it unfold over the last 3 months. I think, as a mechanism, I think we're going to continue to see projects experimenting with, sort of distributing community ownership and governance. I think it's going to be experimented on in all new ways. I think as a concept, it's extremely powerful, and we're seeing how powerful it is. Most of the projects that are using it aren't necessarily unique visions with strong, character and using it for good. They're using it for just, let's do it because we can. So it's going to be wild to watch this unfold. But I think people are going to start to combine, these ideas of community distribution with actually launching extremely novel and innovative and powerful financial products or communities or non-financial products. And I think we're going to see this continuing to happen in 10 years. It's like the best analogy I have is like, well, if, every single customer of Nike wound up being a shareholder in Nike, how crazy would that be? I think we'll start to see these communities, share ownership and governance for things that don't look like financial products. We're going to see this model like tweaked upon in very interesting ways. So we were sort of, accidentally lucky that we were there at the beginning of it. And it really has set off this mania in DeFi, and hopefully it cools down and, people can start to like suss out like what are the distributions of tokens for genuine projects and what, where are they for, what can we safely ignore?
It really is fascinating, and it's been our perspective that when we covered even just the announcement of comp token and how you'd get it, no one had any idea that this would roll into everything that we're seeing today. So it really has been, the story of the summer for me at least. But I think something that doesn't get enough credit, maybe it does within different institutional crypto teams and just people that participate in the market. But I think more broadly, when you talk to people outside the industry, there's kind of this underrated just lack of awareness of just how critical Genesis Capital is to making this all function. Largely behind closed doors, or not closed doors, but behind like the purview of things that we're seeing obviously going on and the yield farming craze, which is very public and loud and exciting. But equally exciting, and really which is kind of driving a lot of these attractive yield opportunities more on BlockFi's side, is the role that Genesis plays in this industry. So I'm curious, Matt, if you can kind of highlight, and we get this question a lot, which is with the success of BlockFi's not only originations or total AUM, but just the fact that they've been able to offer 8% on stablecoins for as long as they have, 6% on Bitcoin for as long as they have, and then there's interest accounts. I'm wondering if you can kind of unpack the unit economics behind that and how this all really works. Like, is it really too good to be true? And kind of highlighting that for wider audience would be interesting.
Yeah, no, absolutely. It's a really good question. And it's certainly a question that we get a lot at Genesis when we're talking to prospective lenders, or capital pools is, how is it possible that you guys can pay 8% on stablecoin or cash? Why is that so much different than traditional markets? What's driving, the discrepancy there? And then a lot of the times, people are skeptical to hear those kinds of rates because they immediately think that there's more risk associated with, that opportunity. And so on one end, you have lenders that are like trying to figure out what is the right interest rate for me to basically loan out my capital, earn interest, knowing the either platform risk that I'm taking, whether, if you're kind of going the DeFi route, or what's the credit and counterparty risk that I'm taking if you're going kind of the more centralized lending route. And then on the other end, we feel like what sets Genesis apart is the fact that we're, kind of uniquely positioned in the middle. Our roots are obviously in trading and understanding OTC markets and understanding exchanges and the nuances of the market structure and who all of the participants are that are actually utilizing the end capital. And so we see where the deployment of wealth goes. We see, who's using it, how often, what they're deploying it towards. And so, I think we're really a nexus point in the space to kind of understand the economics around lending, why rates are the way they are. I think the best explanation for it, there's really two factors at play. There's obviously a lot more, but I think these are the two major ones. One is that the market structure is still super inefficient. There's a lot of structural arbitrage in the space where for an example to highlight one is kind of the discrepancy between futures markets and spot markets, for example. And because you have this tremendous amount of speculation built up amongst retail traders, they tend to use less capital intensive products like futures or forwards or perpetual swaps to get exposure to the asset they want to take a bet on. And so what you'll see is a lot of these derivative exchanges, whether it's BitMEX or FTX or Binance or OKX, you'll see the future prices on Bitcoin or some of the other assets trading well above where spot markets are trading, so long as the market's kind of in a bullish regime. And what basically, so that structural arbitrage, it just exists because there's a natural bid on the futures. There's a natural bid on the perpetuals because they're less capital intensive, and you could take the same view. Now, the issue is there's not enough kind of cash in the system for the market makers and the arbitrage funds to actually come in and kind of squash that premium. And so it tends to persist for quite a while. And so what you see is that future price might be trading, right now it's basically trading, call it $200 above where the spot is out to December. And so if you're a trading firm, what you can do is basically borrow cash, you buy the spot contract, you sell that December future, and you simply capture the premium between the two products. And then, basically that return divided by your investment amount over the life cycle of the return or of the trading period gets you your kind of annualized implied rate. And because this arbitrage exists, like those rates can be implied of like 12, 15, 18, 20% plus sometimes, where it makes sense to borrow cash at 8% all day long. And so what we see is there's a lot of firms out there that understand the dynamics that want to capture the arb, but there's not enough capital from traditional lenders, or whether that's banks or whether it's asset managers or like traditional credit firms like you'd see in traditional markets, in crypto markets. And so they're not willing to take the risk. They don't understand the nuances. And so the premiums persist. And that's obviously the gap we're trying to bridge, is like, how do we bring more real capital, more real dollars into the space to lend out to the trading firms and to the hedge funds to basically, bring markets more in line or make them more efficient. But until there's enough, supply to meet the demand, these rates might persist for a long time. And so that's kind of how the economics are working. And that's why, firms like, BlockFi or Genesis can offer such a high, rate of return on cash, is because there's just inefficiency everywhere. And we can kind of make risk adjusted, bets on which firms might be able to kind of best deploy that capital.
It's really helpful. I mean, just to unpack it, when it's just like a question that we get all the time, and that was a good explanation. I'm wondering, just given what Rob's mentioned, and you talk about this massive demand coming from the traders and funds that are operating in the space, and that market itself that is growing, the players coming in are growing. I'm wondering, just given where you sit, if you have heard or have noticed there's an interest from that group of investors and traders. And you mentioned your background at Bridgewater. Is there an interest in getting more involved and kind of extending out on that risk curve into some of the opportunities in DeFi? Do you get those kind of questions?
Yeah, so I think there's a couple of things. Like, one is just we've now really started to see over the last, call it 6 months, some real interest from banks, large asset managers that might want to start dabbling into lending capital to the space, where a year or 2 years ago they just didn't understand it enough. The markets weren't as developed, and so now that the infrastructure exists, see the rate, the rates that they can actually earn on capital, they've probably done their homework to say, what do the risks look like? Who are the counterparties that we can face? And so we actually, even at Genesis, we just structured our first, basically, line of credit with a bank, pretty active major bank in the space that now kind of understands the nuances, and they're willing to kind of lend capital into it. And so, our hope is that we see that continue to increase with, not only, banks within crypto markets, but obviously some of the larger names like Goldman or JP, where, they can face the trusted counterparties and large dealers in the space, and kind of, deploy their balance sheet towards the opportunity. So we are seeing that transformation. It's pretty slow moving, but, we're obviously doing our best to educate, and that's why we put out our quarterly, insights reports, to try and help larger, lenders understand what the risks associated with lending are, how to think about credit and counterparty risk, how to think about exchange risk, and why the economics are the way they are. Because it doesn't necessarily mean that there's more risk associated with the trade. It's just really due to the kind of structural inefficiency in the space. So that's what we're seeing on one end. And then on the DeFi side, we are getting a lot more requests to on both sides. One lender saying, what's going on here? How can I earn 200% annualized on cash here if I deploy it on various DeFi platforms? And then on the other side, like a lot of the active hedge funds that we faced, are also starting to try and find alpha, within those markets, whether it's through liquidity mining, or just various, cross-platform arbitrage. And so we have to be obviously pretty selective with, who we want to engage with as it pertains to that, because, we have to have a good sense of like, if they understand the protocol, can they actually generate alpha doing it? Do they have the balance sheet behind them if something were to go wrong, where we're comfortable taking that risk? So we're definitely seeing a lot more, interest in DeFi on both the borrowing side and on the lending side, just because of, how hot and relevant, the topic's been lately.
And not to interject, but maybe touch on, I know we've talked about this separately, but it's also probably helpful for you guys in those conversations, and I know it is for us, just to have the track record in times of volatility when you're having conversations with traditional firms whose instinct might be crypto's super risky. How could you possibly lend in the space conservatively? But for someone like you, who's, I don't even know when y'all made your first loan, 3 years ago, 4 years ago now, like, yeah, you can just point them to the data.
100%. It's a really good point. And I think like that's how you build a track record and, your reputation over time, is by, managing a loan book, right, of $1 billion plus through, drawdowns of 50% plus in a day. So, thinking back to what happened in March, like it was a crazy time in markets, but it was also a great opportunity to kind of show the space that even despite the crazy volatility, we've built our infrastructure on the risk side and the operations side where we can handle a move like that. And obviously, weather that kind of storm. And so, yeah, for Genesis, we're super excited that, that was a great stress test for us. It was a great stress test for the space. We came out with no capital losses or defaults through that period of time. And then since then, it's been rapid growth, during kind of the most recent bull run again. So, we're prepared for really any kind of increase in volatility on either side, if that's prices falling or prices rising. I think we're set up from a risk infrastructure perspective to manage that. And I think as more lenders can show, that track record, it will be, it will be something to highlight as we kind of continue to educate like the larger, traditional asset managers or, banks out there that might be thinking about, coming into the space. It's something to point to say, yeah, this can be done well, and the risks, can be mitigated properly.
Before we move forward, a great perspective there. I think, Rob, another question we always get as well is, well, contrasting to the CeFi, where does the yield in DeFi come from? Like if you have an investor base that's driving some of these opportunities in the CeFi and centralized lending, is it largely still driven by investors, but a different type of profile of investor, maybe more crypto specific funds? I'm wondering if you have some quick thoughts there from where you sit.
Yeah, so I mean, prior to any token distributions, Compound was a working product for years with the exact same sort of use case and similar sort of Venn diagram of users as centralized lenders, right? People used the Compound protocol because they had crypto and they wanted to borrow against it to do something, right? Obviously, that leans extremely sophisticated. That's not a retail thing, right? Like very few retail people are using a smart contract on a blockchain in order to get extra liquidity. That's very sophisticated behavior. And so, we've seen that like the use cases, are the same. We've seen the users are generally the same. And, over time, I think that like where the opportunities come from are the same, right? It's just, are you using, a counterparty or are you using a protocol? That's really the fundamental difference. And I think otherwise, like they're very similar.
Excellent. Okay, so I think one more key theme before we move into the questions portion of this discussion. Reminder, please submit any questions in the tab if you have them, and we'll try and get to as many of them as possible. I want to kind of shift gears a bit and discuss what you guys see are either new opportunities or products in Zach's case, and how you see the next 12 to 16 months evolving. Zach, let's start with you. You guys have already begun diversifying the business. You've made a lot of key hires this past year. You guys really are firing on all cylinders. You obviously have the credit card that pays Bitcoin rewards coming out at some point in the next year. I'm wondering, just kind of fast forwarding, even beyond that, what do you think would be a conservative bet or conservative view on what you think is going to unfold over the next 6 to 12 months, and what do you think is more of a bold prediction on some of the things we've talked about today?
Yeah, sure. I mean, so for BlockFi specifically, we've made some great progress this year on the retail side, launching a mobile app, adding fiat on and off ramps, and next year we'll be foraying into unsecured consumer credit with a Bitcoin rewards credit card, and some cool features that we're adding to the platform along the way. On the institutional side, we're working via partners, and in some cases directly with clients to just enable the capital efficiency that Matt was alluding to for certain types of market activities more effectively than how we've done in the past with certain transactions. So stay tuned for some news from us on that front. And in terms of predictions overall, I think all of this is going to keep growing. I think the activity on centralized platforms, the activity on decentralized platforms, the attention on the asset class. I think there are just so many, both macro and micro tailwinds for this space that I've never been, more excited to be a part of. And I tweeted earlier today that what I wanted for my birthday was for Bitcoin to cross 11K, and that's happening. So it's all just so exciting. So in addition to all the good stuff that's going to happen at our respective companies or protocols, I'm very bullish on the underlying assets, at least the big two, Bitcoin and Ether, in terms of price appreciation, which then leads to a larger total market cap and helps move us to a world where, to Matt's point earlier in the chat, not over voice, there are still a lot of traditional financial market participants and investors who this asset class is still small for, and the infrastructure supporting this asset class is still small for. So there's still a lot of wood to chop there in terms of just growth and in terms of building out ramps and different types of structures that enable that connectivity more efficiently, and that's really exciting.
Quick follow-up there, and then I'll move on to the others. Have you heard any chatter from more traditional? JP Morgan was mentioned earlier, but with the OCC interpretive letter, do you see that kind of juicing the flywheel and having these larger institutions consider crypto lending? Is that a consideration you think that could come into play?
I think it helps. I mean, I guess the OCC letter was kind of directed specifically at banks. I think there might be some interesting stuff going on at the OCC right now with Brian Brooks trying to kind of reinvigorate the spirit of the fintech charter that got shut down a while back because it was challenged by the state of New York. I think you're more likely to see startups or kind of crossover fintechs or traditional financial services firms who lean into crypto, taking advantage of regulatory certainty to improve their platform or expand access on their platform to cryptocurrency over the next year or two than you are to see JP Morgan integrate Bitcoin into any part of their existing product suite. They might start doing investment banking or corporate kind of cash treasury management, stuff like that. But even if the largest banks got the crystal clear green light from every regulator, which isn't just the OCC, they also have to answer to other folks that Bitcoin was perfectly fine for them to custody and work with and build products around. It's going to take them 2 years to decide that they should actually do it, figure out how they're going to do it, and go through the entire kind of product development process that a bureaucratic, large organization like that has to go through before a product actually gets to market. 2 years is actually probably a conservative estimate in that regard. But I think you'll see innovation from other folks.
Totally. Rob, what about you? What's your kind of forward outlook over the next 12 to 16 months? Conservative and bold assumptions.
Yeah, so I think, in terms of conservative. I think, what I see from the perspective of the compound ecosystem is the protocol will continue to be upgraded by the community in slow and steady and methodical ways. I think, you'll see some really nice improvements there. I think in sort of like the larger DeFi ecosystem, we're going to see a boom and bust cycle. Like it's going to happen in DeFi. Like there's too many products that are too new and too fly by night. And we're going to see a lot of investors get really excited, and we're going to see a lot of investors get really like burned by some pretty bad products, both in terms of, just speculative losses and, there's going to be at least one disaster. There's going to be like a product that's completely unaudited and people pile $500 million into, and it just implodes, right? There's going to be like risks and issues there. On the positive side, I do see there's starting to be like a lot more of a hospitable environment for well understood, clean products and opportunities. So I think we're going to start to see more exchanges starting to plug into protocols like Compound. We're going to see more applications and institutions start to plug into applications like Compound. And I think we're going to start to see like more of a blending of CeFi and DeFi over the next, year or 2 years. Like it's going to go from being a thing that's extremely experimental to being perceived as like back-end rails that can be shared by multiple different entities at once. And so I think that's really positive. And I think a lot of the work that's coming, out of, regulators is starting to understand, what makes, a net beneficial product and what makes a dangerous product. And we're going to start to see, good and bad, products being segmented in some ways. So that's what I see over time. It's just becoming more a part of the actual ecosystem and not being this scary thing, and it being like a really positive thing that people start to understand.
Great. I share the same view. And then real quick, Matt, just kind of what's your forward outlook? And then we can move on to the questions.
Yeah, for sure. I think, an interesting trend that we've noticed is, I think in terms of like the entrance of like, institutions in the space and, whether that's on the borrowing side or lending side, it starts with like the very innovative, hedge funds, right? The guys that want to generate alpha. Then you saw, and those folks started coming into the space probably, towards the end of 2018, maybe a bit sooner. Then you saw a lot of the large quant trading desks like Jane Street, Jump, and Susquehanna, and just kind of get involved because they realize that, these markets are super inefficient. We can generate alpha trading these markets. And so let's just repurpose our, trading infrastructure to crypto, and we can basically use this as another alpha source. But the most exciting one is the beta funds, right? The funds that just want to get passive allocation to the space and the growth of those funds, because those can be really meaningful. And you're starting to see the transition now. And so what was really exciting, for us was when, Tudor Jones obviously invested in the space. And then also, MicroStrategy more recently, and their accumulation of BTC, as their inflation hedge. I think if you see more and more of those kinds of events, it starts with the super innovative ones, but then it becomes the really, really large sovereign wealth funds, the really large pension funds, the large, mutual funds, basically all looking for some sort of passive allocation to Bitcoin and to the space at large. And so we're kind of waiting for that last phase of it. And I think that's going to be a really big catalyst, over the next year or so. And another interesting kind of dynamic that, that we see playing out too is, there's going to be a generational shift in terms of who's actually managing those pools of capital. And right now, it's probably folks in their, mid 40s to, 70s, as our generation who's kind of grown up with the digital age, more of the millennial generation kind of become, more senior in terms of managing those pools of capital. They're gonna be much more familiar with crypto as an asset class. They're gonna understand what Bitcoin is, and they're probably gonna be more likely to actually allocate to the space. So that'll be an interesting kind of shift of decision making that we think would obviously kind of drive more just activity in the space generally. And then from Genesis perspective, we're just trying to position ourselves really as like the nexus point for all these capital flows, and we're trying to do it by being a one-stop shop across both trading, spot, derivatives, lending assets, whether that's crypto or stablecoin or fiat. And then obviously allowing, lenders and pools of capital to earn yield on their assets as well. And so, we've made the decision obviously to focus solely on the institutional side, but, we think that yield, generally is going to be table stakes. We think every exchange is going to offer yield. We think every wallet provider is going to have yield services. We think every custodian is going to, incentivize users to custody assets with them by providing yield. And so we're setting ourselves up from a tech perspective to kind of be the back end flow for all of those programs where, they don't need to know the nuances themselves. They can basically just partner with Genesis, who understands the actual capital market infrastructure, and then can deploy that capital seamlessly, into the demand that we spoke about earlier. And so, you saw the news recently where, we partnered with folks like Luno and Circle, who have obviously access to a large amount of retail deposit aggregation. And they're just going to use Genesis as, their vehicle to go deploy that capital seamlessly as the demand continues to increase for the reasons, I just mentioned. So, we're super excited. We think the growth is going to be tremendous, and, just trying to position ourselves to, help accommodate that and continue to educate the space on what's out there.
Awesome. All right. So we're going to try and get through as many questions as possible. Panelists, just try and keep the answers as short and succinct as possible. But also before that, anyone that hasn't answered the poll question, give that a click. We're polling to see what listeners find to be more comfortable putting their money in, whether that's CeFi or an audited smart contract like Compound. And right now it's split 60-40 in favor of CeFi. All right, so let's run through these. First one I'm going to serve up to Zach. What did you make of today's news that Kraken has obtained a Wyoming bank license? How does that impact? And this kind of gets into what Matt was just saying. Everyone's going to offer yield. Exchanges are going to offer yield. I guess just how do you feel like this impacts not only your business but industry at large?
I think it's great for the space. I think that it's going to be helpful to Kraken. As I understand it, there were some states where they weren't able to as actively operate as they were in others. If you read the blog post, on Kraken's website, they talk about kind of their plans in terms of products and how this will evolve over time and what it will enable them to do. The way that license is set up, it's tough to lend, at least in the same way that firms like BlockFi and Genesis Capital lend today. So we'll see. They talked about a debit card, so I think you're going to see a nice evolution of products, but I think it'll be some time before they get into some of the key products that BlockFi is known for, like a yield on Bitcoin or a credit card, because of that new charter. But it's great. Look, we want regulatory innovation. Right now at BlockFi, we manage an MSB at the federal level and then over 50 different state level lending and money transmission licenses. It'd be much better if we could kind of consolidate that using a state bank charter or some type of fintech like charter from the OCC. And so I think it's a big positive overall.
Nice. This one I'm going to send to Rob. We get this also, just kind of the complaint with DeFi lending and money market protocols is the inefficiency of over collateralizing your position. I'm wondering, and this is definitely a lengthy topic, but high level view, is uncollateralized loans, delegated credit, a possibility in the near term? And how can decentralized protocols entities help facilitate microcredit opportunities for underbanked or unbanked individuals? So definitely a long question, but
yeah,
what are your thoughts there?
Yeah, it's a great question. So the reason why over-collateralization works is because an on-chain protocol needs to be autonomous and self-insulated, right? It doesn't, work very well right now when it needs to rely on things that aren't already on the blockchain. And so over-collateralized works phenomenally for an on-chain autonomous protocol because all of the pieces are already there. You have the collateral, you can price it, you can manage it, you can liquidate it, everything works. And so over-collateralization is great. I mean, I'm pretty sure a lot of the borrowers that Genesis, interfaces with are also doing over-collateralized borrowing, right? For some people or users or customers, it works fantastic. Is it annoying? Absolutely, right? Is it annoying that your house has to be worth more than the mortgage? Sure it is, right? But over collateralized, is so effective because you don't have to really like understand the counterparty. You don't have to say, if you're in Genesis's shoes or BlockFi's shoes, do we trust them? Do we know enough about their business, their balance sheet, their operations that they don't need to over collateralize this? And, I absolutely think that's more efficient. I think this will slowly come to DeFi. Slowly is the key word, because you have to avoid issues, you have to avoid losses. And so I think it is partially in the future. I have looked at a lot of approaches right now, and I'm not impressed with a lot of the ideas that are out there for being able to like do this at scale on a blockchain. So I still think we're like a way away from this actually working in DeFi. It's going to start with centralized institutions first. They're going to prove the model. They're going to demonstrate that it works. And over time, these things can be fully productized, automated, and made completely trustless on-chain. So I think what's going to happen is we're going to take, as an industry, the best pieces that work from CeFi and bring them into DeFi and make them trustless and bulletproof over time.
Nice. Matt, kind of talk about the sustainability of rates from your perspective. If banks are more comfortable facing crypto funds and other counterparties, and that market grows, do you expect rates to come in? And if so, how long do you think these 8 to 12% rates can last?
Yeah, it's good. It's a good question. And I think you just have to think about it as like a spectrum. So crypto is one end of the spectrum where there's a lot of inefficiency, and take just kind of general markets, whether it's equities, fixed income, you're looking at much lower rates. And I think it really just comes down to how much capital is available in those markets, and what is the infrastructure like of those markets. So, for crypto, I think, I do think it will be a gradual, gradual process of rates coming down. I still think, we're, 2 to 3 years away from some of the larger banks really actually deploying capital to, in a meaningful way, to the space. But I still think also, even if we did unlock, call it another $1 billion, $2 billion, $3 billion from some, real institutional lenders, I don't think that that's enough to totally kind of crush the arbitrage that exists in the space today, just given how much of a bid there is from retail and how much speculation there currently is, being expressed via futures products and via derivatives. So I think there's still time, but it will definitely gradually, get there. I think, markets will become more efficient. There's going to be some innovative lenders that decide to, take the risk and actually put their balance sheet towards this. And when that happens, rates will come down. It's just a supply and demand game. And so, I think we're on the extreme end of the spectrum now. Over the next 2 to 3 years, I do expect rates to come in a bit.
Nice. Rob, this one's more for you, and it's kind of a loaded question, and we didn't really talk about risks that much. I think it's still pretty opaque and hard to really size up. We also haven't talked about any regulatory issues, but a question we have is, do you and Zach kind of hit on this earlier. Do you consider one of the value props of protocol lending, even if it isn't an anonymous founder, but someone like Compound, a way to kind of elude or skirt very clear traditional banking regulation?
Yeah, so I'll start with risks. Over time, I think on-chain protocols will be perceived as dramatically safer than off-chain ones. For the same reason that it's easier to trust Bitcoin than it is to trust any random exchange built on top of Bitcoin. So in terms of risks, over time, DeFi will be safer than centralized solutions, period, full stop. Bitcoin is safer than anything built on top of it. And the users that can interact with the protocol will be perceived as, being safer than, the users who have to trust it to Quadriga or whatever blowups we've had in the past, Mt. Gox, like all of these disasters. Bitcoin doesn't fail, centralized businesses on top of it fail. In terms of the regulatory piece, I actually see it unfolding exactly like Bitcoin, which is the protocol is autonomous. It's not controlled by anybody. It runs forever. the gateways to it might wind up looking like exchanges. I think over time, you wind up with DeFi applications that are as immutable and autonomous and decentralized, see Zach, as a protocol like Bitcoin, and the businesses on top of it, like exchanges, like BlockFi, like all of these on and off ramps to it, wind up being the gatekeepers for most users. Some users will always use the protocols themselves, and that's the sort of landscape that I see unfolding.
Nice. And then one last question, and then we'll wrap this up. We kind of talked about it with Matt, but wondering your perspective, Rob, on, and this is kind of a budding narrative over the past month, but potential for CeFi and DeFi integrations long term. We talked about how BlockFi benefits from the just where Genesis sits as like the nexus between these flows. Could CeFi also benefit from where Compound sits and being to leverage that yield to pass on to their own consumers that maybe don't want to interact with DeFi or don't trust it?
Oh yeah, I mean, without a doubt, what I see happening is, users don't want to use smart contracts themselves, period. That's not like the use case that I envision long term. Like, just like most users don't know how TCP/IP works, but they know that the websites they use are great, right? Over time, I think there's going to be easier and easier and easier sort of products to interact with DeFi systems, where you're going to do this through exchanges. You're going to do this through popular wallets. You're not, as a user, going to be interacting with smart contracts yourself. That's crazy. Like, that's like the dawn of DeFi type stuff that like we're going to look back and be like, grandkids, back in the day, you had to use the smart contract yourself with your own private keys, and it's going to sound crazy, right? As opposed to like, oh yeah, like I have money and it goes up, and it's just like, I don't know how it works behind the scenes. I just know that I like it and it works and it doesn't fail. So I think that that's really going to be like the primary way that people interact with these systems is through exchanges and through custodians and through awesome applications and through E-Trade one day, and that's the future.
Awesome. Okay, thanks guys. That was great. Thanks everyone for joining today. I learned definitely, there's just so much happening, and so it's always good to catch up with everyone that participated today. We'll definitely have a recording up, I think, hopefully by the end of the day, and look forward to doing more of these in the future. Thanks everyone.
Sounds good, man. Thanks for having us. Appreciate it. Take care, guys.